Well, thanks a lot for having me. It's great to be on again. I'm here to talk about the uranium sector. But before I do that, we've of course got the obligatory disclaimers and speed reading test, two of those in fact, and I'd like to do an introduction to Bannerman and spend a few minutes talking about the company that we've built, which will also help everyone out there understand why I can be so immersed in the uranium sector and have the pleasure of sharing a few insights and a bit of knowledge today. Bannerman has a current market capitalisation of sub 200 million. We've got no debt, and at the end of the financial year, boasted 12.5 million in cash. It's a very strong board, good register, and as you can see from that share price graph, we've started to enjoy the rebasing and appreciation that the entire uranium sector has had since the end of last year. Our project in Namibia is the Etango project. It's a globally significant project with an enormous uranium resource. We have low technical risk. It's a conventional truck and shovel open pit bulk mine project. And Namibia, as you can see from that slide, has excellent supporting infrastructure, as well as being an established uranium jurisdiction that has supported the exportation of uranium for more than 45 years. We've been there since 2005 and we've established a very strong in-country presence. I had the benefit and privilege of actually living in Namibia for almost 6 years myself. So I understand the country very well, and we've got an in-country team of Namibians. And what we've introduced with our project over those 15 or so years is more recently a degree of scalability that complements the exceptional leverage that our project scale offers. With this next slide, I'd like to share with you the Etango journey. As I said, we've been focused since 2005, not only in the uranium sector, but on this asset in Namibia. In the early years, we were fortunate to have raised money during a very significant uranium boom. And we used those funds to do the very expensive resource drilling and early feasibility study work associated with a very large project such as this. Now, as we all know, after 2011, this sector went into a deep bear market. And whilst we had some low cost of capital funds still available to us, as that bear market wore on, we needed to be more and more careful and vigilant with the way that we spent that money. This work was all driven towards the large-scale Etango project at a throughput of 20 million tonnes, which would deliver average annual production of 7.2 million pounds of U3O8, a giant in this sector, and when built would be a top 10 uranium mine in the world. But in the last couple of years, we started working on some scaling options. We wanted to have a second avenue, a second road or pathway with which we could adapt to some of the changing market dynamics after this bear market. And a year ago, we were very fortunate and pleased to release the Etango 8 scoping study. And that created a new goalpost, an alternative, but very much parallel opportunity to develop our asset at an 8 million tonne per annum throughput. And very recently, in fact, just this week, we've now released the pre-feasibility study for that Etango 8 project. So let's just spend a couple of minutes looking at Etango 8. So first of all, as I say, it's an 8 million tonne reduced throughput, hence the 8 in Etango 8. We'll be producing 3.5 million pounds per annum over a 15-year mine life for 53 million pounds of total production from a much larger resource of 207.8 million pounds. There's a very high processing yield of 87%, with a low strip ratio, which then generates an operating cash, total cash, including royalties, of under $40 a pound. With an upfront pre-production capital of 274 million and an assumed uranium price of $64 a pound, we generate a post-tax NPV of $222 million US. Our payback is under 4 years, and we generate a post-tax internal rate of return of slightly more than 20%. We talked a bit about how big our resources are. It is world-class. It's almost 208 million pounds of resource just at Etango. We do have satellite deposits on top of that, and an ore reserve for the Etango 8 project of 60 million pounds. Bear in mind that the deposit is also open at depth, and that ore reserve could expand from there. The key upside that also enhances our leverage to the uranium sector is the chance to expand. Either expand the mine life or expand production while we're a uranium producer and profitable. You can see the final pit design for the Etango 8. That's after 15 years or 53 million pounds. Now, if we go back to the original 20 million tonne project, you can see that partway through the project and its ultimate mine life, it's simply a increased scale of what we're already doing. Now, I'd really encourage you to go and have a proper look at the vast technical disclosures that we've included for the PFS. And that is the path forward. As you can see from that, we're looking at being in production by 2025. And when I talk about the uranium sector, you'll see why that is a significant milestone to be aiming for in terms of sector deficits that we expect to open up. Now, I'd like to spend just a couple of minutes talking about something that is extremely important in mining generally, but certainly to the uranium sector. And that's license to operate, both legal license to operate, but also social license to operate. First of all, Namibia. As I say, I lived there for 6 years. It was a fabulous experience. It's a very stable country. It's got a long history of exporting uranium, and it's got a long history since independence of stable politics, safe and secure, and a strong rule of law. The government regularly loses court cases, which is a good thing in Africa. Turning now to social license to operate. Over more than a decade, we've built up some serious environmental credentials in country, highlighted by a baseline that goes all the way back to 2008 and our environmental clearance certificates already in place. We've got social credibility as well, and our social leadership includes being regarded by both industry and community as leaders in CSR or ESG in Namibia, and also building up trusted relationships with the community over those 10, 15 years. And finally, we've got strong government support. We've been in country for a long time, and we also have a 5% local shareholder, the One Economy Foundation, which is a very important part of the social responsibility construct in Namibia. Turning to permitting, we have a mineral deposit retention license, which for our stage of development is really the ideal form of tenure. It gives us flexibility and security. And we do have the Etango Mine Environmental Clearance Certificate in place, and the external infrastructure or linear infrastructure environmental certificates also in place. As I say, we have support both at a community, political, and government level. But if I take a step out for a moment, what does this mine do at a global level? As well as all of that local impact, we have a very serious impact via the fact that we have scale and we're in the uranium sector. As you can see from those numbers, we, once in production, will seriously move the dial on decarbonisation. And when we start talking about uranium, you'll see just why that is so important for the advantages to our sector, but also directly to our company and our capacity to finance. So in summary, we have a world-class asset with a very serious and large scale of asset, where the economics are robust, as you've seen from those PFS numbers. We've got a strong environmental, social and government support. We're in Namibia, which has been exporting uranium for more than 45 years. The project is de-risked technically. Not only has it had a vast body of high quality technical work, we've run a pilot plant, and now we've further de-risked the Etango 8 pathway to development through a robust PFS that confirmed the scoping study numbers. And finally, with the development of Etango 8 and these dual pathways to development, we have an alternative streamlined development path with low development hurdles and a pathway to production by 2025 that then enables us, once in production and profitable, to consider increasing the scale, potentially all the way up to the originally envisaged 7.2 million pounds of uranium per annum. Now I'd like to turn to the uranium sector. And as you can tell from all of that, we are embedded in this sector. And because we've got such strong leverage to the sector, I've had the pleasure and opportunity of becoming somewhat well-known, you could say, in the uranium sector. I currently co-chair the World Nuclear Association's committee or subgroup that determines the nuclear fuel and uranium demand out to 2040 as part of their nuclear fuel report. I also am an expert contributor to the UN's Economic Commission for Europe on uranium and have had various roles at Namibian and international industry level. So I'd like to share that with you just so that you can understand that I do spend a lot of time thinking about uranium in the bigger picture, but also I've had a lot of opportunities to talk to people in this sector and really embed myself in what makes this sector and the broader nuclear sector tick. So the uranium sector is characterized today by some very attractive dynamics today, but also with very strong key thematic drivers that will define the tomorrow. So if we look at the dynamics today, the first thing to understand is we are in a sector deficit. We're running a deficit of about 20 million pounds per annum versus total consumption in reactors of about 175 million pounds. That 20 million pound deficit is after taking into account secondary supply sources. On top of that, last year, the sector had an additional deficit that was caused by COVID-related supply disruption. Those supply disruptions were predominantly in Canada and Kazakhstan, but also in Namibia, which is the third or fourth largest producer of uranium. Now, in addition, we expect those COVID disruptions to extend. We did have Cigar Lake, the world's largest uranium mine, offline for a period of this year. Kazakhstan is just starting to flag that they might have further production disruptions as they move into lockdown and start to achieve their largest case numbers in the history of the pandemic, and the inevitable disruption at the edges to mines around the world as they continue to adapt. And that might only be a few percent here or there, but of course it adds up, particularly when a sector's already running a substantial production deficit. Now, against that immediate deficit, we also have the decade of depletion in this sector. So over the course of this decade, 4 of the world's top 10 uranium mines run out of ore. In fact, 2 of those mines, Ranger and Cominac in Niger, have already closed. On top of that, the nature of Kazakh production, and Kazakhstan does dominate the uranium sector, the nature of Kazakh ISR production is that many of those assets that have really delivered the cheapest uranium into the sector over the last 10 years, they will start to deplete and they will start to taper off. Where does the supply come from? Well, it's really quite limited. And that is because there's been a deep underinvestment in uranium development. That's partly because of the bear market and also driven by the fact that political implications restrict the number of uranium ore bodies that can be contenders for development. And we've seen that even more recently with uranium bans in Sweden and looks likely in Greenland. Against all of that supply disruption, there's steady demand growth. This is a growing industry driven by China and their decarbonisation imperative, but also the key markets of India, Russia, and the Middle East. Because of the decarbonisation, we're also seeing the traditional markets, such as the US and the EU, reverse a trend over the last decade of declining nuclear power production. And we do expect those markets to start growing again as decarbonisation drives a whole range of policymaker decisions. So what does all that mean right now? This is the World Nuclear Association's nuclear fuel report, demand and supply numbers for uranium. As I said before, I'm very familiar with these because I co-chair the working group that determines those demand lines. We're looking at the reference case scenario. There is a lower case beneath this, but an upper case that I'll come to as well. What you're looking at there is those light blue bars are current production of uranium when the report was published in 2019, and the pale blue bars are secondary supplies. So for example, that's uranium that is produced from wasted or depleted uranium sources when the enrichment technology wasn't as good as it is today. There are a number of mines that have been forced into care and maintenance. That's because it doesn't make sense to run those mines and produce uranium in the current economic paradigm that we have with such low uranium prices coming out of a long-term bear market. Those care and maintenance mines are shown in the gold bars. And there are a small number of projects there that are ready for development, including our Etango project. So what does this all say? Well, what it says is that pink area is unspecified supply. In other words, that is supply that will need to come from mines that are not yet sufficiently advanced for WNA to have them in their database. You could think about that as a deficit. So you can see from 2024, a sector deficit will start to open up. And if we don't see very significant incentive pricing to bring on new projects, that deficit will stay as it is. It'll stay in an unspecified or an unknown supply environment. Now, what I'd like to do here is emphasize that this report was published in 2019. Since then, we've had COVID disruption, particularly in 2020, but also 2021, and the large Kazakh giant Kazatomprom extend some supply discipline measures that they have in place. And as a result of that, the yellow arrows indicate where uranium supply has tracked below the WNA estimates on this chart. As a result of that, there's been inventory drawdown by the utilities to meet that deficit. And we've also experienced the relatively new phenomenon of junior buyers in this sector, competing, as anyone who follows this sector would know, with financial investors such as Yellowcake out of the UK, or the Sprott Physical Uranium Trust, which has now been established with the acquisition of UPC in Canada, next year to list in the US market. I talked before about 2025 being a very important year for that deficit starting to open up, and of course for our production at Bannerman, and that really starts to gap in 2028, which is about the timing that Bannerman would be considering expanding its Etango project and adding additional production. If you move all the way to the right there and look at 2040, I've just indicated where the uppercase scenario would track by 2040. So if we start to see some of the key drivers of nuclear power come to be, as I certainly believe they will, that is more of the supply challenge for this industry that will need to be addressed and achieved by 2040. It's an open market. So of course, the way that that will be addressed and achieved is through increasing incentive prices. The picture of today looks very supportive for the uranium sector, of course, and we've just talked about that. But I'd like to start looking at some of the key thematic drivers that are driving sentiment in this sector and really generating a big flow of funds, particularly from the smart money into the uranium sector. So at a global level, the biggest single driver is the decarbonisation imperative. It's driving a whole range of industries, but it will have a particularly acute effect on uranium because it's a very tight supply picture. In addition to that, expansionary monetary policy is a game changer for commodities generally, And for uranium in particular, we're experiencing geopolitical tensions which have a profound impact on the industry itself. So let's have a look at what these economic paradigms are doing to the uranium sector specifically and its customer base in the form of nuclear power. So the first one is, as we all know, the world's largest economies have now committed to decarbonisation. That will have a profound effect because they now have accountability. They have a deadline. Policymakers and bureaucrats can no longer work with very rough, amorphous estimates, which have typically been serviced by simply introducing more renewables into the system. Now that there's a deadline and a backstop date where decarbonisation will either be achieved or failed, policymakers and bureaucrats have to work with the hard nitty-gritty of economics of energy. And what we know about energy economics is that intermittent renewables have to be firmed. They have to be supported by storage. And that storage equation is becoming more and more expensive, more and more risky, and policymakers are starting to understand that too much intermittent renewables puts at risk the resilience and reliability of an electricity grid, which can have, disastrous effects on an economy. That is golden for nuclear power, particularly since it's a 24/7 clean, emissions-free generator of clean electricity. The electrical output in general will need to increase because of the electrification of everything, not just the electrification of transportation that we hear so much about with EVs, but to achieve decarbonising, particularly within some of the hard to abate sectors, we will see a wholesale transition from other energy sources into the electrical grid, again creating huge opportunities for clean baseload nuclear power. No country is more exposed to the challenges or the opportunities of this than China. And in their 14th five-year plan, they've come out strongly in support of nuclear power, a very direct driver of both today's industry, but also the industry of tomorrow. And then finally, we hear a lot about SMRs, small modular reactors, and next generation nuclear technology. Now, there's a misconception there that they will in some way cannibalize or reduce the amount of demand for conventional large-scale nuclear. And I just don't believe that'll happen. And the reason is that SMRs, small modular reactors, are a far more flexible form of nuclear power that are already being deployed into new markets. They are anticipated to be built in remote locations, in situations where the grid demand is not sufficient for a large-scale nuclear power plant. And also they're being used increasingly for new industrial applications such as district heating and, importantly, for the production of green hydrogen via hot electrolysis, which is far more efficient than today's cold electrolysis technology that's used or will be used for other forms of renewable energy such as solar and wind. And finally, we're probably hearing a lot about the use of SMRs to displace coal generation. And you can go to some of the recent publicity that Bill Gates and Warren Buffett have had with what they're doing in Wyoming, where they are identifying a coal-fired plant that needs to be turned off, using exactly the same grid infrastructure that exists for that, and building an SMR effectively in the car park next door. The coal-fired power station will switch off. A lot of those people will then go and work at the nuclear SMR, which will then switch on with the absolute minimum of disruption to either the grid or the form of baseload electricity that can support other aspects of industry in the area. Now, when we start to look more at the expansionary monetary policy, that's generating, as we all know, as resources investors, a commodity super cycle and a flight to real assets. Where that helps uranium in particular is we haven't, as an industry and as a commodity price, we haven't yet lifted. When you look across the board, most commodities have enjoyed quite spectacular increases in their commodity price over the last 18 or 24 months. Uranium hasn't done that yet. And the smart money, and in particular the money that's transitioning out of relatively low risk bond yields and other forms of static investment, are now eyeing off uranium as an asymmetrical risk profile that carries a lot less downside risk than other commodities. That's creating a real impact in our sector. Because it is a small sector and a relatively small value sector compared to industrial metals such as copper or precious metals such as gold and silver, even the beginnings of the impact of generalist investors and speculators are being felt. Initially in equities, and that's the re-rating that I showed with the Bannerman slide, but also with the development of the Sprott Physical Uranium Trust, the capacity to have an impact at the commodity level itself, which with the force of money is widely expected to increase the uranium price ahead of the natural demand and supply imbalance that will ultimately cause a re-rating. One thing that distinguishes uranium from other commodities is there's a dramatic imbalance geopolitically between the supply and the demand. The United States, for example, consumes about 25% of the world's uranium and produces effectively nothing. Europe accounts for about another 25% of the world's uranium and produces exactly nothing, whilst Kazakhstan accounts for about 40% of the world's uranium supply when they're at full production and consumes nothing. That concentration continues on all the way down the line. In fact, the only country in the world that's got any semblance of balance is Russia on the one hand and Canada on the other, with Russia being heavily weighted towards consumption and Canada being heavily weighted towards supply. All of this works together to create for our sector in particular, both uranium and nuclear power opportunities from the huge attention that's being placed on ESG. Uranium by its very nature is an ideal metal to fulfill ESG requirements. Not only does it have a profound impact on the environment, but in places like Africa, it has a profound social impact and also contributes to important governance objectives of third world countries. On top of that, we are seeing a transition which will enable nuclear power and ultimately uranium to benefit from green finance. These are all of these very strong key thematics. And if we look at how they play off against these core economic paradigms that are driving the world at large, you can start to see that many of these drivers are heavily supported by one or more of those core economic paradigms. Of course, centrally driven by the decarbonisation imperative. It's an exciting company in a truly exciting industry. The uranium sector has just over the last 6 months started to obtain a level of interest from the generalist investors and from people who aren't purely contrarian. And I think as an investor looking at this sector and looking at potential investments in the sector, it's an ideal time to be educating yourself and also starting to make decisions about how to position amongst a relatively small number of investee companies in a truly exciting industry that's destined to grow and appreciate. So thank you very much for having me on.